Credit markets front and center as the president's big bill clears a hurdle in the House on top of everything that just happened with Moody's, as Brian mentioned. Let's get to Rick from Chicago with the bond report, Rick, and how this kind of turnaround in yields may or may not matter.
You know, I think it's hugely important that traders, investors looked past the Moody's news. And maybe they should indeed, because if you consider who understands the Treasury market and all the credit issues the best, it's the end users. And I think that's a big story. But even more so to the point, yes, we look past some of the worst news. Look at a 2-year, okay? Last Wednesday, it was around 406. Today, it challenged that, but look at how it reversed. So if you open the chart up, instead of closing at the highest yields, which it would have if it stayed above that 405 area since the end of Feb, what you see there is lots of failures at 4%. Look at a 10-year, early high yield, 456. Boy, did it reverse. If it would have stayed at 456, it would have been the highest yield close since the middle of February. But maybe the 30-year bond really underscores what's going on better than any other maturity. It was over 5%, a rarity. The last time we closed over 5% was October of 23. But if you zoom back, really the previous episode above 5% goes all the way back to 2007. Here's the moral of the story, Kelly and Brian, is that, yes, investors look past the rating agency, and I think that was a smart idea, but not really past debt and deficits. This tax issue and legislation is going to continue to dominate the news, and the trends really for months has been long-dated Treasury yields moving higher. There's staying power to the debt and deficit story, and I agree with Brian. If you look at what's really driving the debt, it's really hard to say record tax revenues are the problem when spending just seems to outpace record collection. Brian, good job, and back to you.